Hello everyone, today's video is all about capital gains tax and specifically the impact of foreign exchange rates on UK capital gains. So this all stems from a recent court case which was heard in the tribunal, and it surrounds a couple that sold a chalet in Switzerland. UK resident couple sold this property in Switzerland, and the way that they calculated their capital gain was challenged by HMRC. It went to court, and the courts sided with HMRC and they said, look, the rules are prescriptive. This is how you calculate capital gains tax when you've got foreign assets and you have to translate the gain into sterling. And the taxpayer, unfortunately, lost a lot of money by doing it the correct way, as opposed to their suggested way or how they thought it should be. So let's just have a look at some numbers. Now, I've just made up these numbers, but it's based on the case. I don't know how much actually was at stake, other than the fact that the taxpayer lost and HMRC's way of doing it worked out that there was more tax to pay. But here's the what was at stake here. Here's the principle of the whole thing. So let's just assume chalet bought in 2010 for 300,000 euros. Okay, same chalet disposed of today, 2022, for €1 million. Nice gain. So in 12 years, we've made a gain of 700,000 euros. So what's the exchange rate today when that property is sold? Let's just assume it's 1.2 euros to the pound. That gives us a UK sterling gain 583,000, converting the 700 grand euro gain at today's exchange rate. Capital gains tax on non-commercial properties, 28%. Capital gains tax bill on selling this chalet is therefore 163,000. So this is the calculation put on their tax return by the taxpayers in this instance, in this particular case. HMRC opened up an inquiry, said, no, that's not how you do it. Taxpayers said, come on, what's wrong with this? That's the gain. You know, we bought this thing as a euro asset, bought it, sold it. Gain is this, converted at the exchange rate when we sold it. Boom, there's the tax, 163 grand. HMRC said, no, that's not how you do it. And the courts agreed with HMRC. So how do you do it? Well, this is the rule. What you have to do is convert the purchase price and the sales price into sterling at the date of purchase and sale. Okay, so let's just assume, and again, I've just made up these numbers for the point of the illustration, but 2010, assume the euro and sterling exchange rate 1.4 euros to the pound. The cost then of a 300,000 euro chalet in sterling terms in 2010, 214 grand. Fast forward to today, selling the chalet for €1 million, and we've said today's exchange rate 1.2 euros to the pound. Sterling equivalent of the sales proceeds, 833,000. So the gain, difference between the sales proceeds and the cost, yes, we're going to ignore enhancement expenditure, legal fees, stamp duty, all that. Basically, the difference between the sales proceeds and the cost, 619,000 in sterling. But hang on a minute, we've already worked out 583, so you can see there's the difference. The difference being the way that it should be calculated gives rise to a higher gain. And this is what the taxpayers in this court case were kicking off about, saying, how is that fair? So just following on this example, 619,000 gain as opposed to 583. CGT there on at 28% is 173,000. Basically, it's an extra £10,000 of capital gains tax. Now, like I said, I don't really know how much was at stake in this case. Could have been a lot more. But in this example that I've just made up to illustrate the point, taxpayer pays £10,000 more in UK capital gains tax just by how we've calculated the gain using exchange rates. And this is the correct way to do it. So this is UK law. This is taxpayers' way of doing it on their tax return. And the tribunal sided with HMRC and said, look, there's no wiggle room here. This is the law. It's pretty cut and dry. It's not ambiguous. It says you must convert to sterling at the date of purchase, at the date of sale, based on these exchange rates. That's pretty much black and white. There's nothing else you can do about that. So the taxpayer lost. They were forced to pay the extra capital gains tax, more than what they worked out when they submitted their self-assessment. So interestingly enough, the Office of Tax Simplification, the OTS. Now remember, the OTS was set up about 10 or 12 years ago by George Osborne when he became Chancellor, and it was a separate independent body of academics, former tax partners of Big Four accountancy practices, who basically came together to advise the government on how to simplify the UK tax law, which is like 20,000 pages long. And the OTS is still in existence today, and every so often it comes up with recommendations on how to simplify certain aspects of the UK tax law. And one of the suggestions from the OTS was that this should be changed. And actually, they put forward a proposal that this way of calculating it should be more like this way of calculating it. Their proposal was that that's a fairer way. The government rejected their proposals, interestingly enough. Quite a few things that the OTS puts forward, by the way, do get adopted by the government. Other stuff they say, thank you very much for your recommendation, but we won't adopt it. And in this case, they didn't adopt it. So this is still the law. As far as UK capital gains tax is concerned, you have to translate the foreign currency at the date of purchase and sale into the sterling equivalent. And if there's been adverse fluctuations in exchange rates, so be it. You're going to lose out. That's just the way it is. So just interesting there. If you are in that boat and you are thinking of if you have an asset overseas in Spain or France or who knows where, and you're looking at selling it, do bear in mind exchange rates can make a difference, which could also drive the timing, of course, because that is fixed, the start point. Nothing you can do about that, but you could certainly do something about this, the sales point, especially if you expect the exchange rate to move in your favour, as it were, just by holding on an extra 6 months, a year. Yes, it's speculative, but you can see how the maths works and how the rules work, so it could be in your favour to either accelerate that sale or hang on based on how you think the exchange rate will move against sterling. So just an overview there on capital gains tax and foreign currency. If you like this video, please do subscribe, and I'll see you soon.